Welcome everyone to our quarterly update for September 2022. For the third time in a row, which is unusual, I have a negative quarter to report to you. That is, negative for a 50-50 mix of shares and property and cash and fixed interest. The third time since January 1990 and the first time since March 2009. A pretty good start in July, but unfortunately downhill from then. Jostling for top spot this quarter are Australian shares in Australian gold and unhedged international shares in Navy, both of which would have grown to $1.03. In second place, in purple, is New Zealand shares, which would have grown to $1.02. Really, that's a currency story. The New Zealand dollar depreciated by 8% against the US dollar and 2.5% against the Australian dollar. A 50-50 mix of shares and property and cash and fixed interest would have fallen to 98 cents. Still not much good news for 2022. This slide shows the growth of $1 this time for 12 months for those same asset classes. The leader this time is global infrastructure in orange, where $1 invested 12 months ago would have grown to $1.12. In second place, in green, is cash, where $1 invested 12 months ago would be $1.01. Middle of the pack is that 50-50 mix of shares and property and cash and fixed interest, which would have fallen to 90 cents. As I said, 2022 has not been a good year. 1 year is nowhere near long enough. I always say we need to look at least 3 years' data. This slide shows the growth of $1 this time invested over 3 years for those same asset classes. The leader over 3 years is unhedged international shares in Navy, which would have grown to $1.27. In second place, in Australian gold, is Australian shares, which would have grown to $1.14. In third place is global infrastructure in orange, which would have grown to $1.12. Middle of a somewhat disappointing pack is that 50-50 mix of shares and property and cash and fixed interest, which would have grown to $1.03. That's an underwhelming result. Having experienced 3 negative quarters, I thought it was important for us to pause and remind you to retain perspective. While negative quarters aren't fun, they actually aren't all that unusual. This slide shows the incidence of gains, that is, positive returns, over the last 31 years over different time periods. As we can see, 78% of the quarters over this time period produced positive returns. That means that 22% of the time they produced negative returns. However, as we increase the holding period to 1, 2, 3 years and longer, the incidence of negative returns decreases before disappearing altogether. Negative quarters are never pleasant, and we do experience them more painfully than we enjoy positive quarters, but they do happen from time to time. It can be hard to be patient when markets are volatile and uncertainty seems high. This sketch is from American financial advisor Carl Richards, who specialises in communicating financial concepts. He coined the phrase behaviour gap to explain why investors often underperform investments. Essentially, investors underperform investments because of behaviour. It can be very tempting to run for the exit, which usually makes a bad situation worse. Being patient and staying in your seat is always the best advice. But as always, we don't expect you to simply trust us. We want to validate why you should. Here's the evidence. This data is from Delbar, a US investment research company that specialises in comparing the returns between investors and investments. Delbar has found that most investors underperform investments. The reason for the difference is investor behaviour. Selling to buy an alternative fund, usually motivated by fear, the media, or a combination of both, results in transaction costs, time out of the market, and usually selling low and buying high, all caused by being human. The difference, or behaviour gap, for the 2021 calendar year was 10.32%. That's a hefty price to pay. Hold on, I hear you say, 1 year is interesting, but insufficient to draw any conclusions. Here's the same data, this time over 3, 5, 10 and 30 years. Not 10%, but still 3% per annum over each of these time periods. That's pretty compelling evidence. The fundamental reason for the difference was investor behaviour. Sometimes we have to sell investments for legitimate reasons. Fear is never one. If we can stay in our seats, even when the ride is uncomfortable, we will get a better outcome. Or, as Warren Buffett put it in 1989, we can benefit from the fact that the stock market is a device for transferring money from the impatient to the patient. Remain patient and the rewards can be significant. Be impatient and the costs can be equally significant. Thank you all for watching. I look forward to updating you again later in the year.